morning, everyone. Today's discussion is about partnership. We have already discussed about the formation and the operations of partnership businesses. Now we are going to see some more details about the change in the ownership interest. Today's discussion will be about those scenarios which create change in ownership interest in the partnership business. There are two possible reasons because of which the partnership interest might change. Number one, admission of a new partner. When a new partner joins the business, the old partner's ownership interest changes, and then we have to give the new partner some of the ownership, and the remaining is distributed depending upon what they agreed on. The second possible reason because of which the ownership interest changes that includes disassociation of partner or partners. Maybe one or two partners leaves the business. Then again, the ownership of old partners is going to be changed. We're going to start our discussion with admitting a new partner in the business. So, if we talk about this, the scenario is there is a person who is going to join the partnership business. When he's going to join an existing partnership business, there are already owners in the business. So, this person, the new owner, he has two options. First option is that he can purchase his ownership from the existing owners. How do he do that? He directly pay them, and after paying directly, he can have ownership in the business. Directly means personally he pays to the old owners. Business does not get any investment from him. So in this scenario, when he purchased the interest from existing partners, we follow one of the two methods, either the goodwill method or the bonus method. The second choice for this new partner is that he can invest directly in the business, in the partnership business. He can bring cash or any other asset for the business. Again, we have two methods to follow. First one is goodwill method or the bonus method. We will look into these details one by one. Starting with purchase from the partners. The first scenario in which he purchased directly from the partners. If, for example, a new person is joining the business and the old person's partnership interest is same, or you can say their ownership is same, and it matches with what they have investment in the business, like in this scenario, Alf and Bal, they are existing partners, they have capital balances of 50K each. Both of them have 50,000 capital balances. So you can see their capital balances are exactly the same, and also they have 50% interest in the firm. Their ownership is also 50-50%. So what their capital balances tells us exactly the same share of ownership they have in the business. In this scenario, we don't need to revalue anything. We don't need to calculate the bonus because bonus or revaluation, which is goodwill, is needed only when the capital balances are different for existing partners. So in this case, when the Cobb buy half of the Alf's interest for 25K, who is Cobb? Cobb is the new partner. He's purchasing from Alf, one of the existing partner, half of his ownership. So if this is the case, then Alf have to give his ownership to Cobb. Okay. What Cobb is paying to Alf? 25K. 25,000 which Cobb is paying to Alf, this business is not getting it. Alf is getting it as personally. So what will happen as a result? Alf will leave his 25K thousand, or you can say 25,000 of ownership. When he will leave it, his capital will decrease with 25,000, and the Cobb will get his capital, Cobb's capital 25,000. Because Cobb is buying half of Alf's interest, so Alf ownership is 50%. When half is given to Cobb, his partnership interest will remain 25%. So this is the scenario in the table it's discussed. Before the Cobb joins the business, Alf and Bal both have capital balances of 50,000 and 50,000. Both shares equal ownership, 50%, 50%. Once the Cobb enter the business, what happens? Alf give half of his ownership to Cobb. Alf have 50% ownership, so 25% he is giving to Cobb, and he will now have 25%. Bal is not going to be affected because he did not get anything from Coop. Same happens with the capital balances. Alpha's having 50,000 capital before. Now he gave half of his capital to Coop. So if you see after 25 goes to Coop and 25 stays with Alpha. Still, the whole capital is 100 because Coop did not invest anything new in the business. So this is the simplest scenario where we do not need to revalue the business as the ownership of old partners is exactly the same and the calculations are simple. But this is not always true because business is already running. So we all know that at the end of the year, we close many accounts to the partners' capital accounts. So capital balances do change. They don't stay the same. So maybe because of drawings closing, maybe because of withdrawals, maybe because of new investment, the partners' capital accounts will change. So we will usually have the goodwill and the bonus situation. We still are in the first scenario in which the new partner is purchasing directly from one or two or all of the old partners. He is not giving anything to the business. So if we follow the goodwill method from our previous discussions of valuation of the business and business combinations, we already studied about it that if we follow the equity method like we discussed in the partnership previous lecture, that we will be following the equity method for the recording of partnership. So in that case, if you want to calculate the goodwill, you need to calculate the implied fair value exactly like business combinations. So let's see this new example. Alf and Bal both have capital balances of 50K and 40K. You can see it's not 50-50, it's different. And each with 50% interest. What their capital balances tells us that does not match what we have over here. They say the ownership interest is 50-50%, but the capital balances are not 50-50. They are 50 and 40. So in this case, we need to first balance the capital balances to reflect exactly that they have equal interest. Anyways, let's read further. Coop will pay 50K directly to the partners. So Coop is going to pay 50K to the partners. This is his investment. If he's going to pay 50K to the partners, they are not defining exactly is Alpha is getting or Bal. They said partners. So it means directly to both of the partners he is giving 50K and receive 50% interest in the firm. Alf and Bal each keep 25%. So we know that ownership cannot exceed 100. It should stay within 100. So when Cope joins, 50% ownership will stay with him. 25%, as they said, will stay with Alf, and 25% will stay with Bal. And now it's 100. Before, what was the scenario? Both were sharing 50-50, Alf and Bal. Okay, so this is pre and after the admission scenario. Anyways, we need to firstly calculate the goodwill. Why we need to calculate the goodwill? Because this 50-50 ownership interest does not reflect what their capital balances are telling us. So let's check that how much is the goodwill. We need to follow the implied fair value rule in order to calculate the goodwill. How do we know the implied value of the business? I'll take you back to the discussion of business combination where we calculate the implied fair value. The implied fair value is calculated by the investment which you are doing in the business, or you can say cost of investment divided by your ownership percentage. Okay, now here, because the new partner Coop is not giving anything to the business, so we cannot calculate implied fair value from his ownership. So what should we do? We will see out of the old partners who have more investment, just like formation case. Alf have more investment, which is 50K. So we will use Alf investment and his ownership interest to calculate the implied fair value of the business before the co enters. So 50 divided by 0.5, the implied fair value of the business is 100. Out of this 100, 50 is invested by Alf and 40 belongs to Bal. But if you see, there is a difference to together 50 plus 40 is 90. So the difference which is unrecorded, we will say this is the goodwill of old business because it was unrecorded. Now this is the time to record it. When we want to record it, because the co is purchasing from both of them, so this goodwill will be given to both owners, not to one, to both of them. So if we want to give this goodwill to both of them, who are those both, Alf and Bal? So 10 divided by 2, it comes up 5. Both partners who are there in the business, Alf and Bal, they deserve a goodwill of $5. We will not give them, we will increase the goodwill because goodwill is the asset of the business, and we will increase their capital balances with $5. Let me show you the journal entry, then we will record the entry of Co. So let's proceed. I'll come back to this discussion. Let me just first show you the journal entry. So if you see entries for the purchase, if the first part we just discussed, this one, goodwill is $10. Alf and Bal capital both increase with $5. Now let's see how to record the admission of Co because we revalue already the business. So here we come. Before the co joins the business, Alf capital was 50, Bal capital was 40, and together it was 90. Then we calculated goodwill, we revalue the business. And because of this revaluation, because of this goodwill, I will write goodwill for you over here so that you understand revaluation means that we are doing goodwill calculation. So because of this goodwill, Alf and Bal both capital increase with $5. Just now we saw that. After adding this revalued capital, now Alf capital after the revaluation is 50 plus 5, 55. Bal is 40 plus 5, 45. Now you can see we get exactly what is our implied fair value, $100. We calculated in the previous. Anyways, now Cobis, let me show you here. Cobis purchasing from, can you see, Cope will pay 50K directly to both partners and he wants 50% interest. If he wants 50% interest, Alf and Bal needs to give him out of their share. So let's do this calculation now. Alf and Bal capital were again, okay, Cope wants 50% ownership out of 100. The total value is 100. He wants 50%, so 50% of 100 is 50. If he wants this capital, Alf and Bal's capital will decrease because he gave money to them personally. Equally, their capitals will decrease because both of them took equal money. So what I will do, I will decrease the capital balances of Alf and Bal with 25 and 25, and I will give this capital to Co. Once we do this, let's check its effect. Let me show you the journal entry. So Alf and Bal capital is getting debit because they are giving 25 capital to Cope, and Cope capital is increasing with 50. Let's go back after this adjustment. What will happen to the capital balances? So you can see here after this transfer, Alf capital is decreasing with 25. It was 50. 50 minus 25, 30 is his final capital. Bal capital is 20 because 45 minus 25 is 20, and Coke gets a capital of 50. So altogether, this is equal to what their total capital is, 100. So this is how we handle the situation when the new partner directly purchased the ownership interest from the old partners, and we follow goodwill approach. If partners decide that we don't want to revalue the business assets, it means they don't want to calculate the goodwill, then we have second method. That is known as bonus method. So now we will follow what bonus method is. Exactly like formation of the partnership, here admission of the new partner, bonus method is working with the capital of partners. So we will just adjust the partner's capital and we will give interest to the new partner. So let's see this scenario. If Alf and Bal has decided not to revalue the assets or record the goodwill, the bonus method will be used. Cope wants 50% ownership. If he wants 50% ownership, old capitals of Alf was 50 and Bal was 40. So together, the total capital was 90 without revaluation. We're not going to do revaluation. If Cobb wants 50% of it, so 50% of it is, I will multiply 90 with 0.5, so 45. He wants a capital of 45 from whom? From both of the partners, because they took money from him. So if 45 he wants, two partners are going to give him, so each partner will sacrifice 22.5 of his capital. Okay, so this is what I'm going to do over here. Before the admission of the Cobb, Alpha is having a capital of 50, Balva is having the capital of 40. Together the total capital was 90. Now after the admission, Cobb gets a capital of 45. We calculate it here. And then both of the partners, they are giving out of their capitals 22.5, 22.5. Their capital will decrease. Now, when the Cobb is admitted to the partnership, then after that, what will happen to the partner's capital? Al's capital will decrease with 22.5, so it becomes 27.5. Bal capital was 40, it decreased with 22.5, so it becomes 17.5. And Cobb capital is recorded with 45. So the capital, even after the admission of the new partner, is still 90. So the difference between the bonus approach and the goodwill approach is when the new partner purchases directly from the old partner, is this amount at the end. If you see the goodwill approach, the ending amount, the final total should be equal to your revalued business capital. If you see over here, I have it here. Can you see the revalued 100? It should be 100. So that's why we recorded the $10 goodwill. So it should be equal to the revalued assets. But if we follow the bonus method, because we did not revalue, so it will equal to the old capital 90K. So this is the first scenario in which the new partner purchases from the old partner. He does not invest in the business. Okay. What is the journal entry for the bonus method? You can easily see Alf and Bal are decreasing their capital balances because they are giving it to Cobb. So Cobb capital is increasing. We are crediting it. I hope the first scenario is clear to you. Let's move towards the second scenario in which the new partner invests in the business. He brings new assets for the business. So in this scenario, we don't need to, record only the adjustment of the capital. We need to record the investment of the new partner as well. In the previous scenario, he wasn't investing in the business. He was personally giving to the partners. So let's check this scenario. Investment is in existing partnership. When the new partner invests his money or any other asset in the business and he wants an ownership, he has two methods again. We can follow the goodwill method, we can follow the bonus method. In this scenario, we need to think that the goodwill will go to old partners or to new partners. In the previous scenario, we don't need to think. We will straightforward give the goodwill to the old partners because the new partner is not investing anything in the business, so he doesn't deserve to be the part of goodwill. But in this scenario where he is investing in the business, he deserves to be the part of the goodwill because total assets fair value depends on his investment as well. He is also investing. So might be goodwill will be given to him, might be goodwill will be given to the old partners. We need to test this. How can we test this? So there is a rule. If the new partner is paying or investing more than his share in the new assets of the company, let's suppose when he joined the business, the old investment was 10. He's bringing $10 more of investment. So new asset becomes $20. Okay, so we'll see how much his share in the new assets. Is it matching what he is paying? If he's paying more than this, let's suppose he's paying 30 to get the share in the old assets. Let's suppose he wants 50% ownership. So his share in the new assets, if I multiply it with 50%, his share in the new asset will be 10, right? But he's investing how much? 30. He's investing more. Can you see here? If he's paying more, yeah, here he's paying more, then his share in the new assets, it's 10. Then there is some unrecorded asset, goodwill, for the old partners. He is purchasing at a higher price. Why? Because the old business has unrecorded goodwill and he needs to pay for that as well. Who was running old business? Old partners were running the old business. So goodwill will be assigned to the old partners. We can have when the new partner pay less than his share in the new assets of the business. So if he is paying less than his share in the new assets of the business, let's suppose he wants 50% ownership, but he's investing $8, not $10 now. Okay, let's check this out. So the old assets of the business were 10. Okay. Um, he's investing $8, let's suppose. And this is nothing, just ignore it. I'm saying he wants 50% ownership. Okay, and he's bringing $8, his investment, or he's paying $8. Okay, so old assets were 10, he's investing $8, new assets becomes 18, he wants 50% share, so 50% of 18 is 9, right? So now let's check the scenario. If new partner is paying less than his share in the new assets of the company, his share is $9 and he's paying $8. He's paying less. Why he's bringing less investment? Because he is bringing goodwill for the business. So in this case, goodwill will be assigned to him. So we should remember this rule. The new partner pay more than his share, the goodwill is to the old partners, that's why he's paying more, he's investing in a good business, that's why he needs to purchase for higher. And if he's bringing less than his share in the new assets of the business, then in this case goodwill will be going to him because he is bringing goodwill along with other investment. So let's check practically both of the scenarios. Firstly, I will deal with the first one. Goodwill goes to the old partners. Dre and Boy each have capital balances of 40K. Both of them are having 40,000 capital balance and share equally in the firm. Cry will be admitted with with an investment of 50K, or you can say 50,000. So if you see over here, he is investing. Okay, so he's not giving directly to them. So now he is eligible, or we will take his investment for the calculation of goodwill. The rule was if he invests more than his share, goodwill goes to old partners. If the new partner invests less than his share, goodwill goes to him. So let's check. He wants the equal ownership in the business. So before Dre and Boy was there, now Cry is also there. So we have three partners. If they want equal share, everyone will be sharing 1/3, or you can say 33.33%. Anyways, let's check the rule. The new assets, the capital balances of all partners are 40/40. They did not mention any as any liabilities, so we know accounting equation, assets are equals to liabilities plus equity, because in this scenario we don't have any liabilities, so basically assets are equal to liabilities, right? So if the assets are equal to equity, sorry, so equity is 40/40, it means this is the old asset 40/40 because of Dre and Boy. So 40 plus 40, they want new assets, so now 50 will increase because of Cry's investment. So 40 plus 40 plus 50, so the new assets are 130. Let's check what is his share in this new assets. So new assets are 130, Cry will share equal, so 1/3, so his share is 43.3, but he is paying 50, so he's paying more than his share, so goodwill goes to old partners. This is the rule. Now in order to calculate the goodwill, we need to see who has the highest investment, because this is what we see before as well, right? So in this case, because Cry is also investing, so we need to consider him as well. The investment of Dre and Boy is less, 40/40, Whereas Cry has an investment of 50, he has invested more. So the new partner will be helping us in calculating the implied fair value. So formula for implied fair value is your investment cost divided by ownership percentage, right? So Cry's investment is 50 and his ownership percentage, we are taking it as a fraction 1 by 3. So when I do this, the total implied fair value is 150. The goodwill is, if you remember the formula from the business combination for the calculation of goodwill, goodwill was equal to implied fair value minus net assets, implied fair value minus net assets, right? And if you see in this case, we don't have any liabilities, so basically assets are net assets. So if you want to minus, this is implied fair value, I want to deduct net assets out of it. Net assets includes both the old by old partners plus the new by the new partner. Altogether it is 130. These are the net assets. So the goodwill is 20. As we said, goodwill will go to old partners. So 20 divided by 2, because old partners are 2. So each one is going to get $10 of goodwill. Let me show you the journal entry, then we will record the rest stuff. So here's the journal entry. Goodwill gets debit, Dre's capital and Boy's capital gets credit with their respective share in the goodwill. Cry has invested money in the business. How much? 50,000. So we will also record his investment. Show you here. He's bringing cash 50 and Cry's capital gets credit with 50. Let's go back to the revaluated capital accounts after the new investment. So before the investment, Dre and Boy both have capital balances of 40-40. Then we revalue their capital accounts with 10-10. So that after revaluation, the capital balances becomes 50-50. And because of the investment of Cry, he uh, he invested 50, so his capital account is going to increase because of his investment 50. So after his investment, every partner is having 50, 50 and 50, which is 150. As I said, they should be equal to your implied value. And if you see in this calculation, we had an implied value of 150. So it matches with what I have at the end of the goodwill method. Let's move on towards the second goodwill approach, in which the goodwill is given to the new partner. The rule was, if new partner invests less than his share, then in that case we're going to give him goodwill, right? I wrote the full rule over here again, but this is just a reminder. In this scenario which we're going to discuss, this is opposite to this. If new partner is paying more than his share in the new assets of the company, then there is some unrecorded goodwill for the old partners. We know that if he pay more, then goodwill goes to the old partners. But what if he pay less? Then the goodwill goes to him, the new partner. So let's check this scenario. Dre and Boy each have capital balances of 40 and share equally in the firm. Cry will be admitted with an investment of 50. Cry will share 40%. In the previous scenario, he was sharing equally 1 by 3, but now he wants to share 40%. And after his involvement, the Dre and Boy are going to have 30% of ownership. 30%. Total should be 100 now. So 30 is 60 and 40 for Cry. So together it's 100. Let's check. Is more or less than his share? So 130 are the new assets we calculated in the previous page. 40% he wants his share, so that is 52. But he is investing 50, so he's paying less. If he is paying less, it means goodwill goes to him. Don't immediately take a difference and say this is goodwill. No, we follow implied fair value. So let's calculate the implied fair value. What is the rule for the implied fair value? The parent, in the business combination we said parent, right? In partnership we say that the people who invest more, they help us in calculation of goodwill. So in this case, the new partner is investing less. He is investing less than his share. So goodwill will be calculated based on old partners, Dre and Boy. Dre and Boy has investment of 40-40. So the total investment of there is 80 divided by their ownership percentage. They are 2. 30% they want. So together it's 60%. So divided by 0.6. So if I do this, implied value of the business is 133.3. So now this is implied fair value. I need to minus net assets. Net assets are the old assets, the old and the new one. Old 40/40 from the old partners, and the new investment brings new asset. So altogether it's 130. So goodwill is 3.3. It goes to new partner, the complete goodwill. So let's give it to him. Let me show you the journal entry. I'll come back to this discussion. So goodwill gets debit. I'm giving 3.3 to the new partner. He is bringing cash 50. I can tell you about this capital cry. Let's go back to the table. So just focus on this goodwill here, that this is 3.3. Cash 50. How much is his capital? 53.3. How does it comes? Is it correct or not? Let's go back to the revaluation table and it will be clear. So you see over here, before the admission of the new partner, Pri and Boy 40/40 their capital was, we did revaluation, and because of revaluation we get a goodwill of 3.3, which goes to Cry. So after the revaluation, Dre and Boy has 40/40 capital and Cry has 3.3. Then Cry invested $50. So after this, the ending capital balances, Dre and Boy are still 40/40, but Cry is 53.3. And if you see, the total assets are 130, capital is 133.3, which is equal to our implied fair value of 133. So it's correct. And this 53.3 of Cry's capital you can see in this journal entry as well. I hope this concept is clear to you. You should remember the rule. If the new partner invests more than his share, then the goodwill goes to old partners. And in order to calculate implied fair value, we take the investment and the share of new partner. Opposite scenario is when the new partner invests less than his share in the new assets of the business, then he is investing less because he is bringing goodwill as well. So goodwill goes to him. In order to calculate the implied fair value, we take the investment and the share of old partners because they invested more. The new partner is investing less. So this rule, if you will remember, it will be easy for you. I will end my discussion over here. In the next recording, which you will find after some time, you will find out that I'm discussing the bonus method when the new partner invests directly in the business, and also this association of the partner or partners from the business. Take care, everyone. Have a great day.